This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Jeremy Carter, managing partner at Soterra Capital. Soterra Capital is a private investment firm with offices in Austin, Texas and Louisville, Kentucky. We invest in lower middle market private companies with capable management teams and fundamentally strong operations. Most of all, they look to invest with people who share their commitment to excellence, integrity, family, and faith. Jeremy, thank you for joining us.
Thanks for having me.
So what was your background before investing in early stage companies?
I've been an operator. I started my career in engineering. I worked for a company in San Antonio that it was kind of a applied R&D consultancy called Southwest Research, and was doing development projects for mostly global automotive, but some government and a number of different kind of global clientele. And then about 17 years ago, I came to Austin to help start a company called Fallbrook Technologies, and we were doing technology development and licensing, mostly for transmission systems, mostly in bicycling, but also cars, wind turbines, just about anything that rotated. And I was there for 13 years and had a really good time kind of playing every role that you could in the business. Ran an engineering group, set up a production operation in China, ended up there in an M&A and corporate development role, and had a chance to do some licensing and acquisition deals, and just got a flavor for doing deals and moved from there into a little more of a finance and investing space.
Great. So what excites you right now?
Well, what we're doing at Soterra, I would regard us, if we want to try to be the best we can be at anything, it's being good capital allocators and finding opportunities to capture value. And that is really in any field. Our specialty, my business partner who's in Louisville and I both have a really similar background in mechanical systems, and he's a chemical engineer. I was mechanical, but more than anything, basically finding good operations with good recurring sticky cash flows. One space we've been pretty focused of late is we call it managed services. Historically, it might have been called managed communication services. It might have been called telecom, but it's a little broader than your conventional telecom. And so we've done a couple deals there in the last year, and we really, really like the space. Yeah,
that's great. Well, you see a lot of startups and investors out there. What's your advice for people investing in startups? What do you tell them to do before they write that check?
Yeah, people investing. I mean, it to me, whether it's startups or it's blue chips, I actually give a talk at UT along these lines every year. There's the fundamentals are the same. Let's not pretend that necessarily we get to kind of escape the physics of business, if you will. Businesses still have to, they obviously have to generate earnings at some level, at either whether now or some statistical level in the future. And if you're investing in the space, you need to have a good view of value of what you're buying. Well, I spent a lot of time in the seed stage investing space, really where I've kind of evolved in the last 20 years of doing this is basically making sure that I have a really good understanding of how to value businesses. And more than anything, make sure you're not overpaying. And I would say the investor's job in any sense is to assess the predictability and reliability of earnings. And so get a good handle on that. And then just make sure you're dealing with good people. I really can't emphasize that enough. That's how we operate there. There's a lot of people. There's a lot of people you don't have to do business with, and it's a terrible thing to waste time on those just because maybe we're excited about some certain opportunity or something like that. Work with people that you trust and people that really understand the business model that you're investing in. And my investing style has moved very much from being speculative to being a little more value oriented. Hence, that's why I spend my time really working to understand value, which can be done even for startups. We're not just putting our thumb in the wind and hoping. People put these businesses together to generate a cash flow, and they should be able to look at that and say, here's what I think it's going to be worth if you do that, and then discount against it. That's how I think about things as an investor.
Great. Then on the other side of that table, what's your advice for people running startups? What do you tell them to do before they go out to raise funding?
A lot of the same things. I had a mentor when I was at Fallbrook, the company that I mentioned earlier. He fantastic guy named Paul DeHart. He had been with GM for 18 years, Harvard Business School grad, and he put a perspective in me that probably shaped indirectly my career path. He said, you can look at everybody in these business spaces in one of two camps. You either have players or you have spectators. Players are the people on the field that, whatever they decide to do, that's what the team's doing. If we're going to run, then everybody's running. If you're going to pass, then the team's passing. Or if you're going to sit down and suck your thumb, you don't get to choose not to choose. But the best players are the ones that can see the field kind of from the perspective of the people in the stands. And the flip side, the people in the stands can be, they can throw stones and be critical, and they don't have to live with it. But the best of them are the ones that know what it's like to be on the field. And so I shape whether I'm an investor or an operator. As I moved from being an operator to being an investor, one of the things that helped me quite a bit was being able to assess the management team and know what life was like in their world, and actually try to understand the business to the extent that, a lot of deals we've done, I like to say that we want to know it well enough that if I had to step in to be the CEO or CFO, I knew it that well, obviously with some limitation. But thinking about it that way, you want to be able to see the business the way an investor does, or the investor should, and that is particularly how to assess value. And beyond that, it's pretty fundamental. Be a student of finance. And I think there's way too many. In fact, as I've gotten into the role that I'm in now, it's remarkable to me how much I bump into people that just don't really understand how cash flows through a business. And most importantly, how to define value, how to capture value when you've got a cash flow stream. What is your business worth? And when you do different deals, are you adding value or taking it away? It's remarkable how many deals are done that are not accretive to value. We give up more than we bring in. And again, finance is kind of the air we breathe in business, or maybe the better way of saying it's the way we measure the progress to what we're doing. And some people, when I mention, the physics are the same, whether it's a blue chip or a startup, people think of blue chips as big and bureaucratic, but cash still flows through each of them. And in a lot of ways, the startup is trying to be, maybe not big corporate Wall Street type firm, but you've got to have some element of discipline and just operations. Like I said, your job is to make the business as predictable and reliable as possible for those investors. And so, yeah, that's how I would encourage them to think about things.
Cool. Well, let's talk about the state of investing in startups. How do you see the industry evolving from here? You've moved into value-based approach, but where do you think the overall industry is going?
Well, that's a pretty broad question. It probably depends on which industry. I was having a discussion with some friends of mine last night about this SPAC revolution, special purpose investment vehicles or acquisition companies, if you're familiar with those, that in some ways they're public entities that raise public funds to go buy small companies. And typically they're raising $200 to $500 million. And it's striking that the universe of companies that exist out there that would justify that kind of capital infusion is not that big, which means that you got a lot of money moving to deals that are much earlier stage. All that to say, at minimum, there's more money than there is deals out there. And so if I'm in a startup space and I got a good idea, at minimum, I feel like I should be able to get a pretty good valuation up front, especially with all the stimulus that's been hitting the market of late. And if you can't, maybe you just don't have a good enough deal. Again, I think of a lot of these things where we do these businesses to create value. So I think of kind of the financial nature of the market, and SPACs are one example, but I can point to a whole host of examples of just a lot of money flooding the market. So
in the next 5 years, what do you think is the biggest change we're going to see?
Just in financial markets, you mean? It's when you say startups, I can talk about startups in a lot of different ways.
Fundraising, more or less, funding startups, whether it be seed, Series A, Series B, venture level, what have you.
Yeah. Mm-hmm. This is a little hard to say. I'm going to say it in very, broad terms. I think that it is important for any business at any given time. It's hard to predict kind of the macro future. I think it's a more useful thing to understand where we are in the business cycle. And, up to COVID last year, we had been in the longest bull run in history, I think. And now we're kind of restarting a new economic cycle. And it's interesting because I don't know there was a big downturn, but That being said, when you have an environment or you're placed in a cycle where there's more cash than there is deals, you start to get pretty exceptional valuations, which means it's probably a great time to be buying. But markets can get euphoric, which is kind of my opinion of the SPACs that we were just talking about. And so if you're fundraising, I'm going to say the same thing, be disciplined. And if you are disciplined and you manage risk appropriately, I think there's a ton of opportunity right now to raise some cash and position yourself really well for what is undoubtedly, in my mind, going to be some overvaluation in the next few years, if not already. And quite frankly, returns are hard to come by in this environment, which tends to be, if you kind of look at just what's happened in the broad market, public equities are at pretty high valuations. So a ton of money flies into alternative assets, and that even further into venture-backed assets. And so my general view is there's plenty of opportunity to be raising money, raise it smart and demonstrate that you can compound capital. And you've got a lot of opportunity right now.
So let's talk about your investment thesis. What is it, and what's your specific criteria for pursuing a deal?
Yeah, so when I left Fallbrook, my role there, we were doing licensing and M&A deals. And while I was enjoying technology quite a bit, it's one of those it's challenging to predict. When you put a thesis together that has to invent something, that's a hard thing. And so we moved to what I do now at Soterra. I look for very proven, I'll even say often boring and predictable business models that are generating a lot of cash flow. So I mentioned what we're doing in the managed communication space. We are buying companies that are essentially brokerage agents. They're indirect sales channels for communication services. So think like AT&T or RingCentral or Windstream or even Verizon and any of your big communications carriers. They sell about 20% of their business into an indirect sales channel. And that indirect channel, these are mostly sellers. When they sell them, they get a commission on what they sell. And that is on typically a 3-year contract that auto renews. We find that those commission streams tend to stick around for 5 to 8 or 9 or 10 years. So it's sticky, really profitable revenue. And we're in the process of trying to roll those up. We just closed one transaction about 6 weeks ago. We did one late last year and have plans to go buy 5 to 10 of them over the next 12 to 18 months. We like that space a lot, and we're buying them from small agencies. Whether we're just buying a book of business or we're buying their whole company and integrating. And we formed, it is technically a startup. We formed a parent entity called Single Point Communications Group that is buying these. And the goal again is looking to keep capital in the business and compound it as much as we can. And progressively use that as a vehicle to allocate into other sectors, whether it's early stage businesses or similar free cash flowing entities.
Right. Well, you see a lot of the challenges that startups and investors face. What's the main challenge you see your startups face in launching their business and growing it?
Yeah, it's interesting. I probably dance closer to a private equity market than let's call it a venture market. And again, the structures are similar. And one of my struggles in this industry, and I think it's even more so in venture capital, is when you start something relatively new, you don't have a track record. By definition, to an investor base, you're riskier than someone that's been around for 20 years doing the same thing. And as such, when you go to raise money, whether equity or debt, it's interesting how this industry is very focused on liquidity events, whether at a 5 or 10 year horizon, or if you go get into the private equity space, a typical model is maybe a 10-year fund that they're going to deploy with almost a mandate that they're going to sell inside of 10 years, which in some ways almost makes them forced sellers. But what it also does is it along the way, you've got debt terms that are maybe 5 or 10 years, and you've got distributions that they want to come out of that. And if you go do a deal that's, let's say you buy a deal for 5 times EBITDA and somebody wants a 6% distribution, well, there's 30% of your EBITDA going out the door, and you've got taxes going out the door. And if you do a debt deal, depending on the nature of your fund, amortized over, say, 5 years, if you're actually paying down that principal, most of that cash leaves the business. If you're trying to build something of enduring value, you want to keep that cash in the business. You want to let it compound. And so it's a bit of this is not necessarily now, this is always challenge in business. And so, but finding ways to finance deals that allow you to keep cash in the business and maybe have a little bit of a longer term horizon is a great way to do it. And that's very much how we focus on what we're doing.
Right. Then on the other side of that table, what's the challenge you see most investors struggle with these days for those same deals?
Finding deals at a good valuation. That's fundamentally it. And the second then would just be an ability to diligence them and really kind of model them out. I mean, there's some really, really smart people out there. I observe the closer you get to the startup space, it requires more than just analytical thinking. I mean, there's look, you've got some incredibly ingenious startups there, but they're going to be a long way from making money. And you got to have a lot of vision and you got to hope you're right, which is why that venture model tends to put money to a lot of different deals, because it does become kind of a statistical game. How do you discount for however many you're going to be wrong on? And so we will tend to default to ones where the cash flows are a little more proven. And in that case, I think the biggest challenge is negotiating deals that are a fair price.
Well, you see a lot of different applications out there and different subsectors and so forth. If you had to pick one or two to put at the top of the list of being good opportunities, what would you choose?
Well, like I said, we're doing quite a bit in this telecom / managed communication space. COVID was a big tailwind to this, and it helped. I mean, we owned a business in this space, and this roll-up we're doing is underneath the company that we already owned. But we're fundamentally we're selling and building a company that provides the resources that allows us to do what we're doing right now. For me to work from home, and it looks like you working from home, and we're all communicating with each other. That is very much it. Beyond that, I kind of think. I mean, I am very bullish on technology. As is the whole rest of the world. But it's just it's remarkable to me how efficient our economy has become in a lot of different ways. Amazon probably being maybe the biggest example of that. But those type of technology businesses that are allowing us to fundamentally make people's lives busy or easier, which is kind of the value proposition of any business in the world that's worth existing. So telecom has been a big focus for us right now.
Cool. Well, in the last few minutes that we have here, what else should we cover that we haven't?
I've alluded to a decent bit of it. I'm just kind of looking at my notes. Like I said, I think that as in this environment, investors and entrepreneurs need to work really hard to understand value and to boot. Going back to your question of what advice do you give to operators, a very simple piece of advice that I think is really relevant is figure out how to make money on paper first. And a lot of times we have a tendency to go mistake activity for productivity. I started this business. I want to show something. And we get real busy and then realize, we're not necessarily following a plan, or that plan can move around a decent bit. So some focus and discipline and understanding an operation and understanding how it's going to make money. We spent a lot of time really breaking down business models to get down to the 2 or 3 kind of key KPIs that say, okay, every time I talk to a business that looks like this, I can kind of measure them on these 2 or 3 things. And once I have that, I can get to evaluation pretty quickly. And then thinking strategically about what that looks like when we pull it in. And I think there's a lot of smart people doing exactly what I'm saying, but it's remarkable to me, again, how much I bump into operators and even investors that don't think quite as quantitatively as I think you need to make money in this environment. And the other thing on that, I mean, you alluded to a little bit in our ethos at Soterra. I've talked an awful lot about kind of financial mechanics and we model a lot of things, building strong cultures of discipline, cultures that care about human beings with a view to say, hey, I'm gonna work in this business for a very long time, whether you're going to or not. I think those are pretty critical to building some long-term value.
Cool. Well, how best for listeners to get back in touch with you?
I suppose LinkedIn is probably the easiest way to do it. I've got a profile out there. Soterra Capital has a profile out there. Either of those, you can kind of check us out. We are going to be looking to acquire in the space. And while we feel that our equity is incredibly valuable, there's a few deals that we may be issuing some equity on. So if there's an investor that's looking for what I believe will be a pretty stable and predictable return, we'd love to talk to them. Or if there's some of these communication services businesses out there that are looking to sell, we'd love to talk to them. And quite frankly, we're always looking for people that might be useful to join the team or kind of help out in any way. So would love to hear from some folks.
Great. Well, I want to thank you for joining us today and hope to have you back for a follow-up soon.
Yeah, sure. Thanks for the time. Really appreciated it.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.